Good evening, ladies and gentlemen. From Germany here, Pascal speaking. It is Wednesday and it is Federal Reserve meeting today. In about 10 minutes we will have the interest rate decision, and 15 minutes later we will have the press conference. So let's prepare for the meeting and see where the stock market is standing right now. Let's begin with Nasdaq, like always here. So as you can see, I made some profits from a smaller short I opened yesterday, which was closed tonight. I will just show you this trade and then we can speak about the levels. So yesterday we went higher here, as you can see, and right before the closing, here was the closing, we were about to hit 12,900 points. And there I wanted to take a short just for 50 points, and as you can see, we hit this level here during the night, during the Asian session, and I could close this short, this smaller short here, with a small profit, as you can see, of $1,300. I didn't trade Nasdaq today before the meeting, but as you can see, we're again trading higher and we're back at the previous highs of 12,945 was the high today, and 12,950, if I can remember, was the previous high point. If I go back, it was a March future back then, but as you can see here, on February 2nd, we were trading at high points of 12,950, right before the earnings of Amazon, Google, and what was the third one? I cannot remember, but yeah, this was the previous high point. And of course, the June future, which we are trading now, was trading higher back then, but March future, which was front contract months, was trading at this level. So it is a high point and therefore it is an important level here. So we made a 100% reversal from the lows here of March 12th back to the previous high points from February 2nd. Now, if we go back again, then let's see the levels to the downside. I will just use my Fibonacci again from the high to previous low points, and the next important level to the downside will be 12,672. This was the low point of yesterday, and the next one will be 12,500 points. This was the low point of Monday. So these 2 points will be important to the downside and to the higher side. Let's see to the upside here. I will go on a weekly time frame to see the higher chart levels. We had a high point here on January 30th, which was at 13,087. These are back adjusted contracts here. Therefore, we were just above 13,000 here. So this can also be the next important level, just about 100 points away to the upside. And then here you see the Fibonacci extension at 161. This is far away, 13,650 points. But for sure the next level will be this one here back from September, where we had the high point right before the bad CPI numbers, and then we had this huge drop until October. So this will be the two important levels here to the upside if we can see a further rally. I don't believe that we will see this, maybe just touch the 13,000 and retest the previous highs here of 13,088 points or 13,100. Let's see. This would already be a big rally because we are already up today about 0.4%. But let's see, we have to prepare for everything like always. And yeah, to the downside, we have our next levels here. 50% Fibonacci, 12,375. I don't expect the market to go there today because I believe we will have these 25 basis points move. I'm telling you this for 2 weeks now, but yeah, the market is now expecting the same like I am. With 83% expectancy, we will see a 25 basis points rate hike and only 17% expectancy for no change. And for the next meetings, we will probably see one further rise, 52% probability for a 25 basis points rate hike in May. then stay there in June and drop in July and September, and end the year at 4.5%. So almost no change from our previous live stream here. Yeah, so this is the important thing for today, and as well it will affect Euro USD. And as we can see, the euro is gaining traction again. Here we had the outbreak above the previous high points here yesterday, and we are rising further. So in just 5 trading days, you can see from the lows to the highs, we had about 2.7% in rise of euro against US dollar. Not bad, but of course it can reverse if the Fed is speaking more hawkish, or in terms of general, Jerome Powell is speaking more hawkish than dovish. Then of course the euro will tank again and the US dollar will get stronger here. So what did I do today? I shorted some Tesla stocks. As you can see, I'm in the green, but only a small position for my portfolio. And yeah, it's just trading sideways. So you can see it was strong yesterday. It was up more than 6%, while Nasdaq was only 1% green, because we talked about it, the better rating from Moody's and good numbers from Shanghai factory and sales numbers in Europe. But today it's just about flat, minus 0.3%, while the Nasdaq is up 0.4%. So it's weaker than the market overall. And I wanted to short near the 200 level, and we reached it at the opening. So I was a little bit early with my short, but yeah, a little bit green, just 90 bucks. And I will hold this one through the Fed meeting. And I opened a new position in wheat. Oops, here's the wheat future on a 5-minute time frame. Let's see this on a daily first. We hit the lows here from March 9th and went a little lower. As you can see, there was a sell-off, triggered some stop losses and went back to 664 cents right now. So I opened a long position here in the futures, and I opened an options position. So I bought a call, a 700 strike call, and I sold a 585 strike put. So this is called a risk reversal, and I will close the future as soon as we close this gap here. So near 680, I will close the long futures, and I will hold to my risk reversal. Okay, so 2 minutes to the meeting. Let's see here our economic calendar for the decision. Interest rate from 4.75, 25 basis points up to 5% is the forecast. And then the press conference, not in 15 minutes, but in 30 minutes. So we will have 30 minutes just of some movements in the stock market without any sense. And then we will see what Jerome Powell has to say. So it can be interesting to take a short here near the 13,000 maybe, if we will see a rise. I don't know if I really want to trade it today, but yeah, maybe I will take a small long position here just with 1 or 2 micro Nasdaq futures just prepared. Because even if it's just in line, I think there was enough of a rally here for the previous 2 days. Just preparing these orders here. So okay, so now we are prepared. Let's go back to this here and see it on a 1 minute time frame. 15 seconds left. Oh, already moving. 10 seconds. 3 seconds. And boom! To the upside. Did we get the 25 basis points? Probably yes. I don't see it yet, but yeah, it must have been in line because the market is not moving big here. Just holding its current level. Trading a little bit higher. I will wait short maybe near the 13,000 level. Just not waiting for too long, because then we will drop again probably. So let's wait and then enter the market right near the 13,000 area. It's always risky to do these trades, therefore I'm only doing it with small amounts. Entering right here near the 13,000 level. Let's see if we can push up to the 13,000 or if we will drop already back. Just opened 5 micro Nasdaq futures, as you can see. And my target is back the breakout level here, 12,925 or 30, whatever you want. Yeah, let's do 30. Just close them right away and take the profits back. So, so here are my orders, 9. It's looking good for this reversal here. Let's see if we can drop back to the breakout level. 25 basis points, yeah, perfect. That's what I wanted to see. Wow, it's moving fast. Maybe I missed the out here. This was the high point, so previous high point is acting as a support, of course. So as you can see, previous high point here acted as a support. So this would have been the earlier and better out maybe. But I still believe that we can see a downshift here. Just a little party that everything was in line. But it's not really a big thing to move 25 basis points, because this was the expectation for several days now. And if we look back 2 weeks, then we had 50 basis points expectation, and even 75 basis points move was 10 or 15% probability. And we are near my level, 12,925. Oh, come on! No! By half a point. I missed it by half a point. Come on, push it down. Half a point. Guys. Come on. Did you want to turn there? No. That's not possible. Come on. Half a point. I should have taken 12,930 instead of 25. Yeah, that's it sometimes. Just some weird moves here. But it's looking good. You can take on more shorts here. I will take on some more. So, okay, I'm in with my preferred position size. Now waiting for the level to come. There's one to go higher. Okay. But we still have 25 minutes without more news before the press conference starts. Therefore, just be patient. It's still green because I entered almost at the high point here. I can show you my entries of today. So here you see I sold at 12,989 and 12,992 points. So right where we are now. Maybe it wants to test the 13,000 level. So it would have been a good out if I would have taken 12,930 instead of 25, but that's sometimes, yeah, crazy like this. But you have seen that it can be easy if you take a good entry point and a good exit point, and if you are prepared good. So unfortunately, I was a little bit too on point with my level, like always, but half a point is really crazy. That's it sometimes. There's the 13,000 level. Let's see. Previous high point was right above 13,000. 13,000 and no, not this one from January. 13,000. Where is it? Go back to 30th January. Here. No. On a weekly. It's on a weekly time frame. Here. 13,088 points for June. This was the June future contract. Let's see if we can go this far to the upside. Yeah, it's pushing more now. Still holding. Just a small position, therefore. Nothing big. Can hold it till 13,080 because it will probably drop and go back and reverse in the press conference. So I will prepare to take on some more here at the 13,080 level. Doesn't want to go this far. 13,045 was the high point. So level is set. Already pulling back here. Yeah, just some weird moves sometimes on FOMC decision day. Just missed hitting the weekly expected high of 13,051. Yeah, just missed by 6 points. So I missed by half a point and it missed the high by 6 points. That's it. Sometimes you're pretty near, but not near enough to get the fill. Therefore, don't be always too much on point. Just give it some room. But it's already pulling back here. And we still have 22 minutes until the press conference. But this 5-minute candle is already looking good. So if we close near the opening price, it's looking pretty good now. Like a thumbstone. And there's 1 minute left to close this candle. Ralph sold 3 M&Q contracts. Yes, nice. Oh, there's a viewer from India. Welcome. Ashrava. Greetings from Germany. So it must be middle of the night here. What time is it in India? 1 a.m., 2 a.m.? Gold and silver position. Yes, Rocket, let's see this gold price. What is it doing here? It's rising a little bit, 1% higher today for gold. But also pulling back now from the high point of 1970 US dollar. Not bad. Yeah, it's moving like the stock market in the same direction here. So it's looking good here for this short. Let's see if I can take some more. I'm already too late for this. Yeah, it's already pulling back. But good, it's fine. I have my 10 micro Nasdaq short, that's okay. And now let's see it pulling back. So let's see my other positions I have. I still have a position here in First Republic, was moving higher, like the market, dropping back a little bit. Almost no change. And DWOC short, DWOC pulled back 3.3%, so it's now in the green, I think 7%. Not bad for this position I opened the day before yesterday. And natural gas also pulling back from the highs of yesterday, 6.6% lower. So yeah, there was a giant squeeze until the settlement yesterday, because we hit the previous lows here on a daily time frame. As you can see here, previous low was $2.24.4, and yesterday the low was $2.24.0. So almost on point, and then the giant squeeze back to the upside. But now we made almost the whole way back to the downside. So let's see what happens here in the next days, if we can still hold these previous lows here, and we will see a double bottom. Then Wix was pulling back, and they made lows at 20.25. So it is pulling a little bit higher now, closed this gap here. German DAX pulling higher as well, 0.6% today. And crude oil, I still have my 50 short put here, 1.5% higher. We almost hit the lower resistance level here. Maybe we can go back into this area, but my short put is now in the green, 51%, not bad for a trade I opened last Friday on the close in the closing of last Friday. Tesla retested 200, pulling back now. Should have shorted more here on the day's high. You can see these levels are working really good. Previous high point acted as a resistance, and we see the same Samstone candle here, and it's pulling back. Same for Nasdaq now, pulling down. Let's see if we can hit it this time, 12,925. 11:40 p.m. Ultra. Okay. So this time 25, please, come on. Hit my level. Sometimes you just need a little bit of patience. Is it crazy? $27.5, come on. Just delete my old orders here. Well, I added my orders. We are already below the levels, and I missed to go out. That's it. Sometimes that's crazy. Okay. But we made new lows here. Maybe we'll retest 12,900 where VWAP is sitting. As you can see, my purple line here is VWAP. So probably we will retest VWAP if we go below the moving averages here, because this candle is looking pretty good. So we went now back to the breakout level. 12,920 was the low. So now we should retest 12,900 as VWAP level. I will place my buyback now there, just to take into account that I was a little bit longer in this trade, so I can make a little bit more on this trade if we go lower. But we are still sitting above the 9 EMA level. Okay, Yeah, of course, the US market will impact every market around the world, even the German market and the Indian market, the Australian market, Japanese market. So everyone is looking on the biggest stock market of the world, the US market. Yeah, I should have get filled, but I was just about to manage my order to set it a little bit lower here. Therefore, I wasn't filled. On the first drop, I wasn't filled by half a point, and here I should have been filled by 5 points, but I was about to edit my order to set it a little bit lower, therefore I wasn't filled. Just give it a little bit more time. We will drop here back to 12,900, and I did set it to 12,905 points, just 20 points more. We'll give it a little bit more room. Here we are, still weak, still wicks on the upper side of the candle. Let's see, breaking these 9 EMA and parabolic. There will probably sit some stop losses here below the previous lows. So we should move pretty fast if we go below 12,920. Let's see if we can hit this level. 15 minutes until the press conference. Do you think when Powell speaks there will be a sell-off? Yeah, there could be. This could be. Especially if he is speaking too hawkish, then there will be a sell-off. So everyone is watching his words now. If he will speak a little bit more dovish than hawkish like the previous times. Especially because he moved by 25 basis points, but we have these big circumstances there with the banks, and yeah, he will probably have to talk about this situation, and especially the future outlook. The Fed dots will be important. So if we see, let's see the Fed dots here, if we can get them, Fed dot plot. Where is it? Unfortunately, I didn't save the link. Where is it? Here. So go to the current meeting and see PDF. Here. So let's see the Fed dot plot. Here. I will bring this up for you. Here we see the projections of the FOMC members for this year and the next years. So now we see what they are expecting, and you see some members are still expecting a higher interest level than we currently have, here above 5%, but some also are expecting a lot lower interest levels than the market is expecting. That just to show you again here from FedWatch tool, what we compare now is the expectation of the FOMC members with the market expectations. So here are the probabilities from the market. So one last step in May and then drop until the end of the year back to 4.5%. What is the expectation from the FOMC members? Dropping back to around 4 and 4.5%. So you see here are the most dots. Therefore we should drop back in about this area in 2024. But here for 2023 they're still expecting 5%. So no dropping here from their expectation, and in 2025 back to about 3% and then 2.5% in the longer run. So you see it is a little bit more hawkish here in terms of the expectation for 2023, and if we will find this in the wording of Jerome Powell, then probably the market should drop, because the market is not expecting this right now. It is expecting that we will see 4.5% and lower levels in the beginning of next year, and not levels above 5%. But almost every member is expecting 5% and higher in 2023. So yeah, it will be interesting if we will see these higher levels here, or if we will see lower levels in the speech, during the speech. Another inside bar, because we couldn't break out at higher levels and not to lower levels. Carlos, I keep seeing people write about how he gives away his intent by the color of his tie, blue or magenta. Yeah, I wouldn't interpret too much in the color of his tie. But of course, you can interpret everything. Yeah, it's sometimes just funny what people are doing. But yeah, every word is interpreted when Jerome Powell is speaking. It's just too funny. So let's see where the press conference will later be. Just to have it here. Yeah, it's here. 8 minutes left. If you want to see it yourself, it's here on the first page of federalreserve.gov. Just mute it until it starts. Then we can watch it together. But I would always focus on the movement of the market and not on the wording. Don't try to interpret his words, it's just nonsense. The market will decide the direction for us, and we just have to take market's direction. We have to interpret the candles and what other market participants are doing, and not what Jerome Powell is saying. We let interpret the others, and we trade direction. So, not moving, still trading sideways here. Let's see this small sell-off, just 50 more points. Let's go back to a 1 minute to see a little bit deeper. Yeah, just moving sideways here. Around the previous high point of today. There was the low point, good to see. Total probability of additional rate hikes are still pretty high on that CME page. 100% for May and 88% for June. Yes, it is still a high probability, of course. So just because of the banks, the inflation is not over. Yeah, you still have inflation at 6%. So we need higher interest rate levels to get this inflation level down. And it will take time. We will probably need until the end of 2024 or beginning of 2025 to get the inflation back to the 2% target. So therefore, it's not bad to see further rate hikes as long as we don't see the recession, but probably we will see within the next 2 months. My opinion is that we will see in June or latest in July, we will see this recession coming pretty fast and pretty heavy. And therefore, we will see dropping in the interest rate level for sure. There's no way around this. we discussed this in the previous live streams. We've always seen big recessions when there were steep interest rate hikes like these, from 0% to now 5% in just a couple of months. It cannot go without a recession, therefore. It's just for sure, and the recession will bring down the inflation, and therefore the Federal Reserve can go lower with the interest rate level. But it takes time, so they are like front runners, so they are the first to decide on the interest rate level, and then they have to wait for the economic numbers and to interpret what the market is doing with their interest rate level. And this takes 3 to 6 months until we see the effect on the inflation. So it takes time until all the banks give the higher interest rate levels to their customers, and then it takes some more weeks and months until we see it in the economic data. And therefore it takes about 3 to 6 months until the Federal Reserve sees the effects of their higher interest rate levels. And this is why they are always in advance with their decisions, and therefore it's so difficult to take these decisions. Yeah, it will be difficult for the banks, but I think 25 more or less basis points are not a big issue for the banks anymore, because they have now the possibility to give their bonds to the Federal Reserve for 100% of the nominal value. So it's not a big issue anymore. Even if they are sitting on big losses, it's just a loss when they have to sell, and they will not have to sell because they can hand in the bonds to the Federal Reserve and get free cash. So it's not an issue for them until they hold to maturity. So yes, they will earn just low interest rates on their bonds, but that's their problem. They bought the bonds. So, but it's not a big thing in terms of illiquidity. Will recession make sell-off on the Nasdaq market? Yeah, I think for sure it will. It will take time. Maybe 1 or 2 months we will see further up runs, but for sure we will see lower levels when there is a recession. But it just takes time that the market is accepting that we won't see further rate hikes, not because of the inflation, but because of the recession and a downturn in inflation because of the recession. And yeah, now we are in party mode because only 25 basis points, and then next month it can be completely different when everyone is fearing again that the recession will be worse than expected. So still 3 minutes. We will see if Jerome Powell is on time or if we will be late some minutes. 12,980, still moving sideways here. Woohoo, party mode, yeah. Always party. Come on, Jerome. Show your tie. Let's see if it's blue or magenta. What happened to Tesla? Also moving sideways here. I still have positions here in oh no, this is not orange juice, this is orange juice. In orange juice short, was not moving a lot today, just 0.3% to the upside. In a sideways range here, I have to be patient and wait. The same for sugar, still in a short position here, but it went up big, unfortunately. 1.8% higher today. Yeah, missed to make new highs here and closed a little lower below the previous low points, so it could also be a false breakout here, but it's not looking too good for my short position here in sugar right now. Okay, still not live. 1 minute left. Let's wait and see. What do you think about all these people talking about bank bail-ins? Yeah, could be, but I don't think that they will do this because it will bring up more fear in the banking sector if they will do bail-ins. So maybe they will just get rid of all the shareholders. Yeah, they, like with Credit Suisse, they lost almost everything. But especially the cocoa bondholders, they lost everything. And this is interesting because normally the cocoa bondholders, they will receive money before the stockholders. But this time it was different. And yeah, they are starting lawsuits now because of this decision from the government and the central bank in Switzerland. But it will take time until there is a decision. But it's worth 17 billion. So of course I would also do a lawsuit. But it wasn't a term sheet that this special situation could be there. So let's see if he is live now. He is here. Yeah. Let's bring this.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole
You have an echo.
to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
There's the sell-off.
Turning to the broader economy and monetary policy. Inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve
focus on price stability
of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy
Let's
categories.
go to 12,900. Come on.
Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change
there
in the
we
core
are,
CPI was
cashing
5.5%.
in. Perfect.
Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high.
This was the drop I waited for.
The
Look at
median
this
projection in the
beautiful
S&P for total PCE inflation is
2.7K
3.3% for this
today.
year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices.
And there's my fill for the Tesla shorts.
My
They are
colleagues and
closed
I are acutely
with
aware
profit.
that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
$400
We are
on the
highly
Tesla
attentive
short.
to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual
this
and
jump
expected
here of
effects of
VWAP
tighter credit conditions on economic
From
activity,
the hammer
the
candle.
labor market, and inflation.
And are going higher
And
back
our
to
policy decisions will
90A.
reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by
Talked
meeting
about these
based on the
projections.
totality of
They
the
are
incoming
clearly
data
hawkish.
and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Let's hear these questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular
Of course,
has
Jerome
ceased?
Powell stressed.
Thanks. So
This
I
decision
guess our
is
view is that
stressful.
the banking
This
system
whole
is
job
sound,
is
it's
stressful.
resilient, it's got strong capital and liquidity.
So I hope we will go
We took
back to the
powerful
previous
actions with
highs, and
Treasury
there I
and the
want to short
FDIC,
again.
which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And
this is a nice
that
candle here.
The intermeeting
For
data
more
on
buyers coming
inflation
in.
and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you
Unfortunately, I
explain
wasn't quick enough with my order.
the difference between
maybe I will get a
ongoing
second
rate
chance here.
increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean,
it's a good resistance zone here, as we can
really
see.
Focused on
but maybe we'll try to push back to the upper line of the resistance area.
Credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see
maybe it was a little bit too high with my entry point.
Before you incorporate
3.5 points higher than the high point here.
Into your forecasts.
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard.
That was the second chance. It's over.
A significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would
maybe we'll
really
get
have
the
the
third
same
one.
effects
Let's
as our policies do. And that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think.
Come on, let's touch this upper line here.
Many banks.
That's it. We are in. Let's see how far we go. Maybe 13,080, 85. So I want to take a second position here at 13,085 points.
You, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not.
10 more points and I will open another short. It's not easy to trade here against the trend, but as you have seen, you sometimes get quick drops here.
So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly.
So I opened my shorts at 13,079 points.
Is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector. And that is
killing the bullets. No, I'm not killing anybody. Just trading. But look at the charts; it's looking good. This was a previous high point.
We don't see that
for June future in January. January 30th. We have seen this level before.
I will say
so we now see a little pullback here.
Point really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
I will hold on these shorts. I will not close them today. So it's a nice level here for a short entry. I will stick to this level
conditions, economic activity,
and not close it today.
Inflation.
So it's a nice entry for holding it for the next day.
How significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and But it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina?
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies.
It's not moving anymore. We are trading sideways here in the range.
At this stage to offer my views.
Let's wait for the breakout.
I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue.
Can we see the break here?
This still happened.
Turning south
so
50
that's really
points.
The nature of the interview. Of the review.
Still holding.
Is to discover that.
And there's the break.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it?
That's a nice drop.
Now thinking that moves might
now
be
back to 9 EMA to retest and then go further down.
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus
this is
based
a nice
on
one.
it will be sufficiently restrictive?
13K level?
Or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring
Let's get
inflation
a
down
VWAP
to
level
2%
again
over
here.
time. It doesn't all have to come from rate hikes.
Half a percentage point left.
From tighter credit conditions. So that we're looking at, and it's highly uncertain how long.
Yeah, it's
the
really
situation
nice
will be
scalping
sustained or
today.
how
Really good
significant
levels.
any of
Didn't
those
expect
effects would
this.
be, so we're
Normally,
just gonna have to
I
watch.
told Ralph I won't trade today during FOMC meeting. But it's so nice to see these levels coming.
We will do enough to bring inflation down to 2%. No one should doubt that.
I don't know, Carlos, if there's a sell-off into the close, but I want to hold this position because it was such a nice level to see a sell-off from the January
Hi, Chair
high.
Powell. Rachel Siegel from
So therefore, I want to
Thank
keep
you for
this
taking our
position
questions.
for
I know we've talked a
maybe
bit about how
200,
Silicon
300
Valley
more
Bank
points
was
to the
unique
downside.
to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized.
Banking system is strong,
I
stronger
really
than the
don't
market.
See that as at all analogous to this.
One other question. Would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So
Price
we
target
will get inflation down to
12,555. Why this number, Ralph?
But they're
It's
working,
400
the
points
spending
more
that's
to the
happening is working
downside.
against what you were doing, right? So it's prolonging inflation?
If you have to look at
I don't trade triple average ETF. I'm trading the future, Rocket, here.
High during the pandemic, and then as the
That's
pandemic
fast enough.
programs rolled off, spending actually came
But
down.
as you see,
So
it can pay off
the sort
pretty
of
well.
Fiscal impulse is
So
actually
about 5K
not
profits here
what's
just
driving
with the
inflation right
micronastic
now.
futures.
It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios.
You are
Two
trading
questions
triple
about
average,
aspects
okay.
of the government's response on Silicon Valley Bank 2 weekends
Back
ago.
to weave up here.
First, why is this new bank funding facility
If you want to take
done
some
under
profits out,
emergency
do it
13.3
now
authority as
here near the
opposed to
VWAP level.
expansion of the discount window,
I will hold
changing
on,
terms of the discount
even if we
window
move
that's
back a
been
little
around
bit.
long time. And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3.
There's VWAP level.
Really no magic to that. It's
Nice
only
to
available
see
in
further
unusual
sell-off.
and exigent circumstances, and it has to meet certain
VWAP should
requirements,
act as a
but it seemed
support,
to be
smaller support
the right
here.
place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an
You
end?
couldn't expect this.
Absolutely not. No, we
By Jerome Powell
if we need to
talking and
raise
answering
hike-
the
raise
questions,
rates
these
higher,
crazy
we
moves
will.
here.
I think for now, though,
Let's see the trades again.
as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect
Here
on
we see
the macroeconomy,
the first
on demand,
take
on
profits
labor market,
at
on inflation, and we're going to be
12,905.
watching to see what that is.
Then the
And we'll
buyback
also
of the
be
Tesla
watching what's
shorts.
happening with inflation. the
And
labor
here I
market.
opened new
So
shorts,
we'll be
as you
watching
can
all those
see,
things.
micro Nasdaq
And, of
and
course,
the larger
we will-
one, NQ
we will
futures short.
Eventually get
So I have
to
2
tighten up policy
NQ
to
futures
inflation
short
at
right now and
2%.
10 micro Nasdaq futures.
We'll find ourselves at that place.
So you see the 10 micro Nasdaq here. And I have 2
Hi, Chair Powell.
NQ
Thanks for
futures
taking the
short as
question.
well.
Kyle Campbell with American Banker.
And this is a nice level. Look
I
at
have a
this.
couple questions
I
about
shorted
the
at
balance sheet.
13,079
First of all,
points.
curious,
This was about the high
at what
point
the
here.
financial supports that the Fed is extending.
High point was
through the discount window to its,
13,081.75
enhanced
and I shorted at
might be at
13,079
odds with
points.
the objective
So
of
just
reducing the balance sheet.
2.75
I'm also
points
curious what
below
your
the high
thoughts
point
are
of the day.
on, not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different
Never
ways.
mess
let me
with
be
Jerome Powell,
clear
yes.
about how I'm thinking about these recent developments.
But no matter what
So
Jerome Powell is
recent
talking about,
liquidity
it's
provision
about
that
the
has
direction.
increased
As
the
you have
size of our
seen,
balance sheet, but the
I'm
intent
caring
and the effects of it are
more
very
about
different
market direction
from
than
what
on Jerome Powell's
from when
words.
we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to
There's
alter
the
the
sell-off
stance of
below
policy by
VWAP,
pushing
so
down,
pretty bearish now.
pushing up the pricing down.
I
the
will
rates,
hold on to my
longer-term rates,
position.
which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions.
So
It's
if we
not
close
intended
near
to
the opening
directly alter
level,
the stance of
and it's a
monetary
pretty
policy.
bearish candle, as you can see, with a huge
We
wick
do
to the
believe that
upside
it's working. It's
at
having its
OG,
intended effect of
which
bolstering
could
confidence in the banking
act
system and
as
thereby
a downside
forestalling what
catalyst,
might otherwise have been
minimum
an
to
abrupt
12,670
and outsized tightening in financial conditions.
and
So
maybe
that's
lower
working. In terms of the
12,500.
distribution of
So
reserves,
I will stick to this short trade here.
we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks. But
yeah, even
but I
Bitcoin
will
pulled
tell
back.
you that
Crypto market is
there have been presentations about interest
it's
rate
like the
risk.
stock
I mean,
market.
it's been in
So
all the newspapers.
when the
It's
money is
not a
pulled out from the
surprise
stock
that there are
market, and
institutions
also
that
we see a drop in
that have had
the crypto
unhedged
market.
long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating.
Look at this drop here.
Nonetheless, what happened
From
happened. And so that's really the purpose of
28.7K back
when
to
we think about the review that Vice
27.8K,
Chair
almost lost
Barr is conducting,
$1,000
is
per
try to
Bitcoin.
understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to
Jerome
that,
Powell
the
is
speed
even
of
affecting the crypto markets.
of the run. It's very
crazy.
different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening.
Do we see more weak signs?
Can you confirm
No
whether or
chance
not
to
the
go back
board
above
knew about
VWAP and
these
90 May, so more
escalations by
sell-off here.
Examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The
Wow,
Economist.
what
Thank you
a
very
nice
much.
sell-off. Look at
Chair
this.
Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools.
So this is the same chart you see here in red where I opened the position.
Deposits are safe.
13,044 and 13,079, almost at the high point. And here you see my profits from these two NQ short
give us a little
futures.
bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley.
Price is
weekend, you
always
said
the same like
the question you
MicroNASDAQ
guys
future.
asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened?
Thank you, Carlos, but it's not over yet.
Sure. So, that was
it's
really
only a
the
winning
Swiss
trade when you have closed
government.
it.
We, of course, were following it over
But
the
it's
course of
good
the
in
weekend.
the green,
and we
so
were engaged with their authorities.
it will probably
in the
not
ways
get
you
red
would expect,
again.
all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole. Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain
Still looking
estimate.
weak here.
And
look at this immediate sell-off.
There's really we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that. And
below yesterday's close. Okay, let's see this.
And get there as quickly as we can.
We are right where we opened about, so it can even turn red, this candle. So let's see. I want to see a close near the current level. This would be perfect for the next 2 trading days.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's what
and more
we don't
sell-off
know
here.
whether that'll happen this time. We don't know.
What a nice turn.
How significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
This was a good question.
It's too early to say, really, whether
soft landing.
Whether these events have had much of an effect. It's hard for me to see how they would have helped.
People catching the falling knives are slowing the sell-off a little bit. No, I don't think, Carlos. So retail investors won't slow
question
down
will be
this
how long this
sell-off
period
here.
is sustained.
Even
The
if they
longer
try
it's
to catch the
sustained,
falling knife.
then the greater will be
Only the big
likely,
traders can stop this.
Declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations taken seriously?
Remember your level, Ralph.
That is a great question. It is
12,555.
right in the heart.
It's a good level. I think we can reach it. So look here, 12,500 is a Fibonacci level.
I think that's
12,505, so even 50 points lower than your level. Could be a nice target here. And the previous low point was 12,525 from Monday.
I wouldn't share them because
so we could see just
really,
the rejection from the previous bull run here before FOMC meeting.
I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Final question.
Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So,
seems to be a difficult question.
Seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions.
Market is trying to find a bottom here, so we are trading sideways.
I mentioned with rate
be
cuts,
a first sign of a
are
smaller
not in our base
reversal
case,
here back to Viva.
And so that's all I have to say. So
thank you.
Thank you very much.
That's it. Jerome Powell has finished. Yeah, what a nice drop here. So perfect entry. No exit for now, so I will keep this position because I like the entry point and I like this daily candle. We still have 45 minutes of trading, but as long as we close near the opening price, it's looking pretty good for a doji. And you see the previous dojis we had, like here, the low one, yeah, from Monday last week. There was a bull run starting, and then there was this doji this Monday. We had a bull run the next day. So we normally see dojis on the upper side as well, as you see here from March 6. And if we see a doji again today, then probably we'll see a drop tomorrow or maybe the next 2 days. Therefore, I will wait minimum for this level here and maybe even for 12,500 to come. So this would be 500 points in about 3 trading days. Let's see if we can catch this one from almost the high point, just 2.75 points below the high point. I entered my second position. This was a nice split here. 6K in the green with the micro Nasdaq futures and about 6.5K with the 2 NQ futures. So really nice for this Federal Reserve meeting. It was a high stress level for you, Ralph, but you have seen I was pretty calm trading today because my levels have come, and I was pretty sure about my trades, so I wasn't stressed at all. I wasn't scalping, so if you are a scalper and you are just in a trade for 10-15 seconds, then yes, you are stressed. But I'm not stressed because I know that my levels will come, and if not, then I will be stop lossed out and I will take the losses. That's it. That's part of trading, of the trading game. It doesn't work always 100% in your direction. You don't have to be right all the time, but you have to accept that you are on the wrong side sometimes. And this is the more important thing, to cut the losses and not to be right all the time. You can be right only 40 or 30% of the time. The more important is how you manage your losers. Yeah, it's just easy. I traded without any volume profile or footprint chart or all these crazy things. I don't need. Why? Because we did this together here. We looked at the previous high points, so we can look back again on a weekly time frame, the previous high point here from September, from January. So we were prepared for the high levels. Yeah, of course, this one was really far away, but for January level, we talked about this before the interest rate decision. 13,087 points was the high point here, and yeah, therefore I decided to go short right below this level, 13,079 points, and the high point was about there, 13,081 point. So it was on point. It was perfect, like the previous exit here with 13,000 and what was it? 12,925. Here it was just 12,925.5. So that happens sometimes if you are too greedy and try to pick up the pennies in front of the steamroller. That's sometimes dangerous. But if you stay patient and then your level gets hit, because you always get a second chance. Yeah, like here, we talked about this. It will go back to VWAP level. So we are back at VWAP. We are even higher. So I could have gone out of the trade and could have re-entered now. But I don't want to trade in both directions. So therefore I will stick to my trade and just hold it for the next 1 or 2 days and see how far we can go to lower levels. But it's an interesting level here to take on more shorts now, because this should act as a resistance here now. Yeah, I can add to my position now. So it's a really interesting point to add to the position. So this is what I will do now here on my other portfolio. Let's see this one. Where is it? Here. Current level 12,940. Go on a 1 minute time frame to see. Yeah, right at the level here. This was a previous high point of the trading day. So it's a nice level to enter more shorts here. And to ride it further down. Yeah, it's not too interesting to watch the charts, but I hope you could get some insights today. And I hope you liked my stream. So if you liked it, then please give me a thumbs up, and of course subscribe to my channel. Hope you could make some money as well as I did. And yeah, let's meet again tomorrow. Let's see the news tomorrow again, so that we see what we have tomorrow. In our economic calendar tomorrow, we have initial jobless claims, not really interesting, but new home sales. This is a 3-star event. So I could do a pre-market stream with a weekly number, but we also have building permits here pre-market, but I don't know if there's a big volume here or if I should do a stream during the opening. So let's do an opening stream here when the market is open, and then the first half an hour there is probably more volume here on the opening. So I can live stream new home sales here. There's my next sell, 12,940. Of course it can go higher, but it's a nice entry for taking on more. And yeah, so let's live stream tomorrow for market open for half an hour until new home sales, and then we can see how far this position is in the money. Thank you for watching. I wish you a nice Wednesday. We will see us tomorrow again if you like. And happy trading. See you next time. Goodbye.